All right, hey everybody. Today we're going to be talking about something that I think is a little bit different and a little bit interesting. I got Conor Lynch here with me, and as all of you know, Conor was the publisher of a group that went from zero to about 50 million, really, really fast. And then they had some regulatory issues, um, uh, and Conor's moved on to other things, and he's launching a new company. What I think is fascinating is that what Conor originally did with his business was something that's very, very understandable to most people who have a newsletter publishing business, right? You have front end products to multiple back end products. The price points are things you're all familiar with and things like that. But now, after having built a $15 million company, he's launching something new and he's not going to take that approach at all. And I think he's going to do a different business model that is better math, better for this current environment, and has a higher likelihood of reaching bigger numbers faster than kind of the traditional model that we think of front end newsletter product to back end newsletter product. And so that's what we're going to be talking about today is what this model is, why he chose to go this route versus what worked before for him, and kind of dig into the details. So Conor, thanks for being here.
Absolutely. I love these. So excited to dive in.
All right, so let's start with let's go back to WealthPress and kind of do a review of what that approach was in terms of, because what we're about to talk about here is a difference in marketing and sales model and a difference in product model. And then with that comes a difference in copy model.
Yep.
So let's go ahead and just kind of go back and look at what was the basic business model, product model of WealthPress when you launched?
Yeah, absolutely. So when we first launched, we didn't actually have any front ends to start. We had a collection of back end offers, and we introduced front ends because that's the acquisition model that everyone in the space was using. You run people to something low priced, under $100, you convert them, and then you sell back ends to those people. Now, we started doing that, and we had a limited level of success, and that was the sort of first year of our growth. And again, it was a traditional model. We would do lead gen to a front end, and then we would sell not just to the front end buyers, we would sell to the entire lead pool backends, which some pubs at different points in the history of the industry didn't even do that. They would sell backends only to front end buyers. I mean, even in the last 5 years, I've heard people say that they do that still, which blows my mind because they didn't think you could sell a backend directly to a free lead, um, much less to cold traffic. When we achieved our big breakthrough, part of it happened on the copy side with the Blitz promo that Kyle Milligan wrote, but the bigger reason why that was a breakthrough for us was because we went up the value and price scale, and we did that to external. So Blitz was I think it was a $2,300 product, and we sold that directly to cold traffic. And I remember at the time, everyone would tell me that that can't work and it won't work. I had, pretty sophisticated media buyers saying like, this is, if it is working for a bit, it's just a fluke. But we got that one to work. We did probably $5 million of external sales on that offer, and realized that you could sell those backends directly to cold traffic. Now, that said, our model after that was very, very similar to what everybody else was doing, which is selling a basket of similar backends, different strategies, different big ideas to that audience. So an individual franchise might have 3 to 5 backend services, and you were constantly in a cycle of killing services that weren't getting a lot of interest, launching new ones, having to write a huge volume of copy across all of those different promotions, have to support all of those different services from a fulfillment perspective, which is manpower intensive. And so in that sense, the WealthPress model beyond the acquisition step was pretty familiar to everybody in the space. It would look the same as what backend monetization would look like for any of the Agora affiliates. And a lot of that we learned from working with Brett Holmes, for example, who was an early consultant with us, who kind of taught us that model. So we built it that way. Our acquisition model was totally different. It was a bit innovative, but everything after that was what the whole industry essentially has been doing for years and years and years and years, which is you have a lead pool, some of whom are buyers, some of whom are non-buyers, and you're marketing $2,000 products, $1,000 to like $2,500 products to those people. And each franchise has to have a catalog of these to work. You can't make a franchise work on a single offer. So that's how we did it at Wealth Press. And even leaving aside the regulatory issues that, I mean, but at this point, everybody knows that story, so we won't dive into that one again. Leaving aside that for a second, we hit other headwinds over that period that would have caused us significant trouble, even if, even leaving aside the FTC. The media costs, everyone's noticed this, media costs across the industry have exploded. Tracking is worse, so the quality of the traffic that you're getting in isn't as good as it could have been in the past. The propensity for people to buy some of these backends, at least over the last like year and a half, 2 years, has not been what it was. I mean, even before the 2000 boom. So the model as it stands now, especially with increased media costs, it's tighter. It's a lot harder to make it work, which puts more demand on copy to really hit above its weight class, which is admittedly somewhat harder with much more intense regulatory scrutiny. So you've got this model that's being squeezed from basically all sides, and everyone's still trying to make that model work. Well, I wouldn't say everyone. There's a few people who are doing what I'm sort of proposing to do who've already made it a success. So I'm not exactly a full pioneer in that sense. But the existing model is under intense pressure. And I mean, the interesting thing to me is I don't think it really has to be. If you look at every other niche outside of financial publishing, even let's isolate it to just the other make money niches, real estate investing, biz op, career op spaces, things like that, make money online. They've all shifted to a model that downplays selling front ends of any kind. Many of these businesses have no front end, nothing for sale, even under a $5,000 price point. And they go direct to a sale at $5,000 or higher and have products that range in price up to $50,000, sometimes $100,000. And our space has been kind of the last to adopt a lot of marketing innovations. We've seen that with the VSL, with webinars, with the product launch structure. And so it's not surprising that our space is the last to kind of move to make this transition as well.
I always laugh when I hear people who are like talking about a company in our space that innovated, some big thing, and you're like, you're
Right.
really disconnected from the rest of the marketing community, because
Yeah,
literally everything
exactly.
you've listed is very much something that happened first, with possibly the exception of like the e-letter.
Yeah.
But
Well,
other
like
than that,
guys like Sam
yeah.
Ovens had been doing this formula of the high ticket telesales thing for what, 10 years, and sold his business like 3 or 4 years ago. So he had the full career of this before we even discovered it as a niche.
Well, you have some people like Zach and Tim who've built a business around a telesales model.
Big time.
And that's kind of what we're going to talk about here, is the difference in building a telesales focused marketing funnel on the front than a product front end to back end, and how this really pulls through every aspect of your business and has a very different experience as a business owner of the business. There are issues, there are limitations in terms of where it could possibly go, but I think that the limitations on it are much higher than people might expect. So yeah, sorry to interject that there, but
no, those are good points.
um,
So where do you think we should take the conversation next?
well, I think the thing is that what I really want to highlight here in the front is that there is an existing acquisition marketing funnel model, right? That then pulls through, like when we think of a direct response business, right? A direct response business is built around an acquisition model fundamentally, because you are going, that is the customer generation, right? You're not a retail business that is relying on foot traffic. You're not doing like all your advertising and all of your marketing is essentially how do you proactively go out and find customers, bring them in and sell them more stuff. And so the business is like, we talk about publishing, but it is, first and foremost a direct response marketing business. That's like the InfoPub business. And there are unique things to financial for sure. But I think sometimes we've spent a lot of time focusing on those unique things, and we need to step back sometimes and be like, wait a second, this is info marketing in the sense of direct response marketing.
Yeah.
And with that, your choice of acquisition model kind of determines your structuring your business. And that means like your product model. In some product models, like I would say the current newsletter product model is very, very copy intense because you have a constant need of promotions.
Yep.
Um, it's very, very like the new ideas constantly. The products you're in order to expand, like each product, like however good your business is at acquiring customers and bringing them in, you kind of have a limitation on the size of any particular product. You'll have an average size of what a good product is in your business, and bigger companies have a bigger average size.
Yep.
But a smaller company will have a smaller average size. And so then in order to grow, you need to then add more product, which puts more work on both your editorial teams, your production teams, your copy teams. You have to find new gurus, maybe you have to add more products. And then you have like this constant kind of churn on your product model, as well as kind of on your customer base, because products work and then they don't work. And so like one of the very normal things in the business is this idea that you have to close a couple of products every year in order to relaunch a new thing, because the new
Yeah.
products are the things that are most profitable, which is entirely a different type of experience than what we're going to talk about next.
Yeah, absolutely. And if you think about it for a second before talking about like what comes next, that whole model of launching, supporting, and then killing services over time is so problematic across multiple dimensions. One, just in terms of the internal resources it costs to support that is extremely expensive. You need copy for each of those offers. You need an editorial support staff for each of those offers. There's customer support costs to maintain each of those offers. I mean, anyone who's worked with a guru who has to support 5 different offers knows that it strains the guru, and it means that their fulfillment across the basket of stuff that they're doing is probably not as good as it would be if it was focused on one thing or one or two things. So that's the internal support cost side. Then the fact that you're constantly killing offers that people got excited about and purchased, sometimes like if you launch a new product in some cases and it bombs completely and they're not able to figure out a way to sell it within 6 months, that thing might not even survive a year. So someone got excited, spent real money, got into the service, was trading it. Maybe they enjoy it, maybe not, who knows? But they were excited at one point and they got in, and now 6 months later they're killed and they're being moved over to some other offer that they weren't necessarily enthusiastic about. And so that's a bad customer experience. It's also not a great customer experience in the sense that people come in, they want to get proximity with the guru. That's a big thing that we know is attractive to the customer base, and they find out that they have to buy like 12 things in order to do that. Also not a great customer experience. Whereas you could get them to spend the same average amount of money on a single offer and have them be thrilled to do it, as opposed to being like, fuck, another offer I have to purchase. Then the third dimension where it's like really not ideal is on the regulatory side. Like if you're constantly killing offers, the perspective on the part of a regulator is going to be like, well, how legitimate can these services be if you're constantly killing them? So it's bad for a number of reasons beyond just the economics.
Right, right. And there's a lot there with that. And that the one of the things that I remember, like it was a frame that Porter Stansberry put forward in 2005, I think it was, when there was a big like kind of Agora marketing conference, and he got up there and was like, there is no Agora model because we're all different businesses. And this is, I'm gonna tell you my view of things. And he's like, I don't think you're paying attention to me if you subscribe to a free e-letter. Like you opted in, you were interested, but you're not really listening. And so he talks to his ascension model and he goes through like, the front end product. Okay, you're paying attention a little bit, but not really. You're not really listening. And he goes up, and it's not until you get to that $25,000 Atlas Club that he's like, I have your attention. You're really paying attention to what we're doing. You're really engaged in the business. Like that's my customer. And so there's this really cool perspective he had on the business. Was essentially what all of us know is that the front end product exists to do two things, right? Normally it's there to subsidize the media cost to acquire a customer and to identify who that paying customer is so that you can sell the higher price products, because someone who's going to put some money out is likely to put more money out. And so that's the initial purpose of the front end product. In terms of just the marketing math, not like the other part of that is like building the relationship is huge there. And that's why the front end product has to be amazing, because you really have to build a great relationship in order to be able to keep them. But what he was saying was more that the perspective is like, my real business is having a system to find that $25,000 buyer, right? And that view on the business is, I think, a little bit different than a lot of people have, because we don't think about it as much, as that, the lower price products are there to find the really great buyers, the hyper buyers at the higher price point. And if you have a model that can identify that guy at a cheaper cost more effectively with less work, maybe that's something that's worth exploring. And that's kind of where we're going to go here next.
That's a really great perspective. And I think that is sort of the transition that I've made in terms of my thinking, but also a number of other pubs in the space have done. The idea that there is a core customer you're looking for, they spend a lot of money. You want to create a very high level, very expensive core customer experience for them. Now, how do you find someone to buy that? Now, you could sell, 500,000 front ends and then sell those people some $2,000 back ends, and then sell those people into an alliance program or something akin to that. But it turns out you don't have to do all those things. You can actually find people relatively cold who are willing to make that higher ticket commitment almost right off the hop. And I think that goes back to, again, that parallel with WealthPress, where people didn't think that people would spend $2,000 off the hop from cold to 40 minutes later, they've given you $2,000. Well, they will. We know that they will. And so I think a lot of pubs still think that people won't necessarily come in and spend that kind of money within a week of knowing you, $5,000, $6,000, $7,000 within a week of knowing you. But the reality is they will. And we see it in these other niches. We see it with a few examples within our niche. Tim Sykes, for example, and Zach, like that's the number one example, but there are other pubs doing it. Stock Navigators, they've got a pretty decent sized business doing this. I saw a funnel today, Prosper Trading. They've got a funnel that does exactly this now.
They've been doing something, the versions that Prosper's been doing a version of this for 20 years.
Well, there you go. So it's it definitely does work, and it's working in niches like Make Money Online, where frankly people are a lot poorer than in our niche. The reality is people have a lot of money to spend on financial information. If you look at the skew of people within our audience and how much money they have to invest, and how valuable good information, good insight, good intelligence is for those people, that it's extremely power law concentrated. So you have this chunk of people who, for them, $5,000 is amazing value to be able to get the right investment advice.
Well, it's not investment advice,
right? Investment research information.
No, I think this is interesting, because this is like, there is this continuum of education to advice, right?
Yeah.
And it's where you kind of place the product on the continuum. And we should get into that, I think, a little bit later here.
Yeah.
But first, let's just lay this out, because what I want to do is like, let's lay out what the model is
Sure.
for people. And then I want to talk through a few things on it. One is the idea of the relationship building that you do with the customer. Two, the copy model that is most effective here. Why I think it's so effective, and I think I'd like to get your take on that. And then also how this changes kind of the acquisition math. And then finally, how this looks, how this affects like the kind of the staffing issues around running a business here. And I think those four areas are pretty much where this gets really, really interesting. And so why don't you go ahead and describe what the model looks like?
Sure. So the way the model kind of works is you're buying cold media into a short lead capture page with typically, to do it well, you want a really, really high quality lead magnet, like something that would be more valuable, higher perceived value than than what people would normally expect to find on a lead capture page. And I'll explain why in just a second, because you're using the lead magnet in more ways than just at the lead capture step. So someone will opt in, they'll land on a page where there's a video between sort of 10 and 30 minutes in length. Most of them kind of land around 20 minutes. And the purpose of this video is a couple things. I mean, the final call to action you're getting here is not for them to buy the program, but for them to complete a qualifying survey and schedule a phone call with a phone sales rep. Now, the reason that you want to have a really, really high perceived value giveaway on the lead capture step is in the opening of the video, you're using that in another way. You're not immediately giving that lead magnet out in an email fulfillment as soon as they opt in. They land in the video. There's the opening promise of the lead, however you're opening it, and then you're telling them if they watch through to the end of the video, they'll get instructions on how to claim their lead magnet. They watch through the promo structure. We'll get a little bit more into promo structure in a second and how the copy works a little bit differently. Towards the end, in the call to action for them to schedule the call, they're told, hey, like when you get on the call, we're going to evaluate you to see if you're fit for the program, but we're also going to give you this free lead magnet. So that's how you collect it. So that's the reason you want something very high quality, high perceived value, because it's not just for capturing the lead, it's to get them to watch the video and to get them to schedule and then show up for the call.
Okay.
And then it's a close. And so in terms of economics, I'll run through economics a little bit actually.
Yeah.
Typically, you're trying to get a CPL somewhere in the $5 to $15 range. You want to get somewhere like 5 to 10% of the viewers of leads basically to complete the survey and schedule a call. And then you're hoping for like 30 to 50% show up rate and 25% close rate on the call itself.
Right. Okay. So it's basically a very qualifying opt-in page to a video that's selling the idea and the conception of your sales call on the program. So you're selling the big idea of the program essentially, but you're not closing them. You're trying to get basically just, it's almost like with a normal lead gen funnel, there's this issue of friction, right? Like that I always use as a measure. So more friction is more qualifying. Less friction, you get more people to opt in, and friction is more things they have to do, more things they have to consume, and every time they consume something and keep going, they are more and more qualified. And then so it's kind of like the simplest version of this is there a link above the fold in the email or a link below the fold in the email, right? Like there's more intent on the, if someone had to scroll down, they actually were paying attention more theoretically to click on it. Same thing with opt-in, like opt in to get this thing versus just click here to see it. Like the person who opted in to get something had to go through a higher level of friction to get it. So they are therefore more qualified. They're more interested. They're paying attention a little bit more than the person on average who just clicked through. And so here you have click through to video. You're going to lose a lot of people, I'm imagining here, who will not schedule a phone call.
Yeah.
Right. Because that's a very high friction step. So the
90
person who
90 to 95% you lose.
Right. So there's a very large number of those people who will be gone, but the people who do schedule the phone call are extraordinarily interested in this, which speaks to one thing that we do know in this business is there's a lot of price elasticity, and that sometimes you'll have a product $2,000. It's not converting super well, so you'll make the thing, oh, I'm going to drop it down to $100 or two, cut the price down, and you don't really get that much more. You get a bonus of people, but it's not that many more to make it worthwhile. The reality is the people who were interested in it were willing to pay way more, but there's just not as many people interested in it. And that's what you're looking for, is those people here who were super interested in this program because they're willing to get on a phone call to get this lead mag and go through this very high friction process to what they probably know is a sales call. They kind of get that. In order to continue down this path because they're so interested. And so from that then, do you do anything with the lost leads?
Yeah, so you do. Typically, so I'm working with a guy who has built a lot of these funnels and niches outside of financial. He's not experienced in the financial publishing space, but literally every other niche that runs this funnel structure. Like he's built these for Frank Curran. He ran this program internally at GKIC for Dan Kennedy. He said that typically when they roll one of these funnels, you don't really think about the email follow-ups or setters or any of those pieces at first. You want the economics to work literally on first run through of the thing. And if it's not working there, then you probably have to go back to the drawing board. But then once that is working, there's a lot you can do with those names. Because again, there are some people who are not ready to spend $5,000 or $6,000 right off the top. So there's typically a sequence that they build that runs over about 30 days that tries to sweep more of that audience in. Some people do things like try to sell a qualifying front end to then push them into it, but not as the initial touch point. Usually like after someone's scheduled a call or deeper into that 30-day sequence. Some of them don't do that at all. But the other big piece that they use is something that is not super common in most of the newsletter space, which is what's called a setter. And for those of you who are not familiar with what a setter does, setter looks at lead scoring, and that could be things like a lead that comes in, maybe watch the video, you have data on how much of it they watched, they didn't schedule a call, but they're continuing to open emails and engage. So they have a high enough lead score that this person manually reaches out and says, hey, I see you're interacting with our stuff. I'd really love to set you up with a demo of the program, or I'd really love to set up a call with our team to answer your questions. And then they kind of help close the gap between some people who, for whatever reason, there's something keeping them from taking action, but they're engaged enough to be interested. So that piece usually gets added at a certain point. So that there are a lot of layers to this, and the sophistication can get quite complicated over time. But again, the model should work with just that sort of first pass.
Right. And then, so there's a lot of things you can do to move people from those leads to get a higher percentage of them. And then if you're an existing publishing business with an existing model, you're using this, you would, of course, after a certain, you could probably just push your other stuff and you get some success there too with that. So I guess the next thing to talk about then, I think, would be the product model itself. And then we'll get to the copy, because I think those are two very interesting things to kind of get into. And so what does a product look like? Because you're coming in at a $5,000 price point. What does the product look like for that? And I guess let me back up one thing. Is, generally speaking, is the concept for the call essentially a demo of the program?
It can be. It often is. It's usually structured in a way so it feels like the person has already started on the call, and it's not like, here's a sales pitch, and then if you agree and give us money, then we start. It's like, no, let's start. We're giving you this lead magnet that's value. We're probably going to demo you through that and kind of future pace the experience of the program. So it feels like you've started. And then it's like, if you wish to continue, then you must pay.
Okay.
So that's
Okay.
Ones that work
makes
well
sense.
work that way.
Right. So once you're moving, then that's like lowering friction on the commitment level that they have. Like, you're getting on the call, you're not like, you're starting the program, we're giving you some of the elements of it for free. You just have to kind of get on here to consume it with us, and then we'll move to a higher friction point of like, give us money, which is the ultimate friction point. All right. So what does the product look like?
So I can answer that a couple ways. Like across the full sort of space where they're using this funnel structure, there's two broad categories of things that I see. One is some sort of educational course that's packaged, usually across an 8 or 12 week like boot camp period that I mean, it's a la carte, so people can go in and go through all 12 weeks or whatever in the first week if they literally just do that. But there's that component. There's usually a community component, and there's usually a live component that's 1 to 3 times a week, I would say, where you're live with the guru, you have proximity, you're able to ask questions, and that proximity is a big piece. Frankly, the community is a big piece, and that's something that a lot of newsletter products have shied away from. The idea. I know there's probably people who are going to watch and listen to this and think like, holy shit, the idea of a forum where my customers can talk to each other sounds terrifying. But it's like, these products are built in a way where they're good fucking products. And because it's the core of the business, product development doesn't end at the point of launch. It continues on an ongoing basis. So the version of the product that you launch compared to the version of it that exists in 6 months or 12 months continues to develop and respond to the customer feedback in the community. So it becomes a stronger thing over time.
Right.
That's
And these
sort
are
of one
not
model.
fundamental. Go ahead, finish, and then I'll.
Yeah, sorry. The other model, which may or may not be applicable to our space, is the commoditized service model, which is more of a B2B thing, but I've seen B2C versions of it, where there's some service. It's not an educational thing. People aren't expecting to get educated on something. They're expecting to get a result or a deliverable of some kind. And again, a lot of this is B2B. So you see agencies do commoditized service packages that they sell this way, um, developers, that kind of thing. I suspect that if you created a really high quality done for you service in certain categories in financial, you could do this. Like the one that stands out to me as obvious is um, private equity, so venture capital stuff. So an early stage private placement done for you service where you have direct proximity to, like if Marin Katusa did a funnel like this, it would definitely fucking work.
Right.
So I think that there's a space for that kind too. But for the most part, what we have seen so far is the educational version, at least in our space.
Right. And I think that's where I'm going to go next is kind of so one of the problems with a lot of community things in our space would be it's with products that are pick based. You're only as good as your last pick when people are talking.
Yeah.
Education based is, and so if you're on that continuum of like this is how to do it versus it's done for you, which traditionally you would think of as the more done for you it is, the higher price it is, which is why a wealth advisor is paying, getting a percentage of your portfolio, which is insane in and of itself. But with education, right, on the other end, it's like here's how to do it. And you would normally think of education as being uh it's like a book. It's less intense until you frame it in the context of like college, university course, um, really like highly skilled things. And I think this is where we go into the copy approach, because from what I've seen, you tell me if this is the way you see it too, is that these are fundamentally guru funnels. It's
100%.
very much about the person and building up the credibility and expertise that you can only get this exact version of this education from this person because it's his method, his model, his unique strategy. Is
Yeah.
that how you see it?
That's 100% the case. It is much more guru driven. One thing that comes up in copy in our space quite a bit with new copywriters who come in from outside the space, they come from niches where virtually every promo is some version of hero's journey. And then they come and they try to write that kind of copy for a newsletter and it bombs completely because that historically doesn't really work that well for 99% of newsletter ideas. It doesn't. In For these sorts of funnels, hero's journey does work because the person buying has an aspirational desire to become a trader, learn that investment skill set, learn that trading skill set, master it themselves. So the idea of following in the path blazed by the guru, that's important. So hero's journey copy not only works but is dominant in this category.
That's interesting. And so I think that's where it's hero's journey, but also like um the proof and credibility element of the guru. Like
Yes.
this is harder. The weaker the credibility and story of the guru, the harder this is to do. And
Yeah.
so like
This is a business model for gurus who are solid and who can stand on their own laurels, uh, without the embellishment that sometimes happens in this space. Guys who could go into a room and actually talk shop on this stuff, and the other guys who know how to talk shop will be like, yeah, this guy gets it.
right. And so I think that's a key component is you need to have somebody who is really good in terms of like maybe their track record, their professional history, their connections, like whatever it is. They have to have a strategy that they use. It's fundamental to how they approach the markets. And the interesting thing to me when I was thinking about this and going back is how, one of the best versions of this has always been Tim Sykes's Millionaire Challenge in my mind,
Yeah.
and how Tim has consistently said, like, this is how I do it. This is what I do. You could probably do it better than I could. In fact, lots of my students have
Yeah.
outperformed me once I taught them how to do this because while I know everything that how to do it, like you're still a trader, and your miles may vary. Like you can be better than me, you could be worse than me. It's the same approach, and that always was interesting to me. It's such an interesting point, right? Because
And he does have that one guy who, I think Tim Grattani, who crushed Sykes's results and is in a lot of
yeah,
the programs now.
yeah, and he has a bunch of students who have gotten up to $1 million in profits and real money. So like he can really he has his own track record, which is proven and phenomenal. He has the statements for. Then he has students' track records now, and so that's very like active trading in what he does. But it's a very niche service. But they've sold hundreds of millions of dollars, right? So like they're amazing at that. And so I think that's the thing, is that you need that guy who is kind of unquestionably good at what he does. And if someone tried to punk him out and say this is BS, he'd be able to kind of slam them.
Yeah.
Right. And so I think that's the key difference in this space, versus kind of how a newsletter guru right now in community right now, like you keep community away because like you have so many editors and things like that who, you know, there's editors who are really good analysts, but they've never really managed money. They've never really traded successfully, but they're really good at doing this piece, you know?
Yeah. Or even, I mean, there could be editors who are good and have a good track record, but they know that just because of the way that statistical distribution works, eventually they're going to have a bad run. And so if it's an entirely picks-based service, if you have a community in there and people buy during a period right before a bad run begins, which statistically is going to happen no matter how good you are, then all of a sudden the vibe in that room is going to be apocalyptic for some
Right.
period of time.
Yeah, exactly. And that's the risk of the community model with a lot of these things. But I think education based, and I think that the education market in this space is very underdeveloped, and because we have this there's a couple of arguments against it that I've heard. One is it's purely trader education, because that's there's no investment education, which I think is a huge hole actually in the market.
I do too.
Two is that there's no like a lot of the publishing business is generally in its, I'd say, best form, is a renewals based business, and there's a lack of renewals on the lower products sometimes because it's a 12-month boot camp or 12-week boot camp.
Yep.
And so the lack of renewal revenue is less attractive when you're selling lower priced education products. I would say that at the $5,000 price point, you're already at a price point where you're getting more money. Your LTV on that one purchase is higher than your LTV on your other customer.
And
It's a
the other
question of
thing,
how many you
to
have.
quickly interject on that, usually you get, when you buy, it's not lifetime access to that community. It's usually like 12 months, and the renewal is usually at the full price.
Okay.
So there is quite a lot of renewal activity. I mean, it's probably similar on a percentage basis that you would see with products in the newsletter category. It may even be higher because the community engagement is so intense. But it definitely doesn't. Your revenue definitely doesn't end at that $5,000 purchase.
Right. Nice. And so then from a copy, like a funnel here, then you were telling me this offline, was that a promo here, like that 20-minute video is the heaviest lift on the copy side.
Yeah.
And that is a 4,000 word video. It's not like a 15,000, 20,000 word promo, hour-long video,
Correct.
that has to do all the heavy lifting. And so the copy approach is actually easier in that sense once the offer in guru
It's
is
not
really
only
picked.
that, when you have one that works, they tend to, because here's the thing, like if you do a promo around, I just reviewed on a copy call with Oxford, James Altucher's recent launch around the Apple Vision Pro launch. And literally this promo went live and was deadline the next morning, which was the time of the launch. So this entire promo was like the launch period where it was active and relevant was 12 hours. So you need to then write a new promo. Whereas these promos, they tend to run for much longer. Minor releads, changes on the landing page, but the core promo could last years, which is unheard of in the financial space. It's much more common in other categories, especially outside of make money. But even in like real estate investment, biz op, copy lasts longer
But
than
and the reason is that it's focused on the guru more than it
exactly.
is on the market, because it's more
Yeah,
important to sell the person than it is to sell what's happening in the marketplace.
that's exactly why. Because
And I
the
think
gurus,
just to interject on this real quick, I think one of the things that I find interesting about this and exciting for especially smaller publishers is like the hardest point of competition in this industry is finding copywriters, high performing copywriters. Um, Despite all the copy education that's been out there and the number of people who have tried to be financial copywriters, the actual talent pool continues to be extraordinarily small. And once somebody gets good enough, they go to MarketWise, they go to the larger publishers because they can get much higher bonuses because those companies have much larger
yeah,
scale. So their promo can run farther. They can make more money. They also get stability, which is a freelancer. Stability is not something a freelance copywriter has, generally speaking. And so uh, finding like great copywriters is the constant struggle of every publisher. And the smaller the publisher is, the harder it is. And it's a huge pain point across the industry. And what's
yep,
interesting about this model is because you don't need as many copy packages, um, the copy package doesn't have to do the entire lift because you have a sales process
yep.
um, that kind of erases. I mean, frankly, I think it erases that pain point almost entirely.
Yeah, it's if you are a smaller pub and instead of having to write 6 packages that are good over the course of a year or 12 or whatever it is, because even a single small franchise could easily need 6 promotions over the course of a year. And either you're writing those internally yourself or you have to find other writers. It's expensive, it's hard to do. Um, with this, it's one offer that could work for multiple years. And you can, with the same resources that you're going after 6 promotions that are going to be dead within 18 months, you could take multiple shots of something that could last years and be a core of your business for that entire period of time for both acquisitions and internal monetization.
Mm-hmm. Right. And so then um, the other main difference is that like the amount of production you need to do on a weekly basis
Way lower.
drops. I mean, it's cutting not in half, it's cutting probably to a tenth of what it was.
Yeah.
Um, you need the sales team, which there's a lot more setter sales groups out there than there are copywriters. So
And
your marketing
because
calendar is different.
Yeah, the other thing to just note on, like, it used to be that finding telesales people and setters was challenging because it was such a niche thing. But over the last, 5 or 6 years, that became a career op in the make money space to become a high ticket closer. And most of the people who sell that as a biz op have a flywheel business where they also take their own graduates and then position them with other companies.
Mm-hmm.
So there are a lot more sources for trained closers and setters than there ever was prior to now.
Yeah, and I have Zach gave me a great contact who he uses to he basically specializes in this, and he can specialize in building helping you build out a team yourself. Um, Also referring people for outsource, and when you're ready to do it like in-house, he can help there. And so there's a lot of good contacts I can share with people who are interested in that. I might actually do a call with him like this and talk about his process on that quite a bit too soon. Because I think it's a growing area, and it's not. And I'm not saying that this should replace necessarily all the newsletter approaches. But it's such an effective model um, that if you have the right guru and the right approach, and like this is an amazing business that is a lot less production work. It's a lot less.
A lot less copy, a lot
And
less production. If you have a franchise with just one of these offers compared to a franchise with 4 or 5 offers, it's a lot less editorial support. It's a lot less, the mail volume, just like the time it takes to queue up and send fulfillment emails across 5 services versus one. There's a lot of extra effort there. I mean, the cost in manpower and production, in terms of production and broadcast alone, to support these more traditional style franchises, I know
Mhm.
because I've done it, it is is expensive. And for a lot of smaller pubs, they see, I think this is a mistake a lot of people make. They look at Agora, for example, and they think, wow, like Agora got so big. And even now, market wise, is still relatively big. Not as big as it once was, but very big. And they look at that model and they say, okay, I'm going to emulate that because that's what the big guys do. But the reality is, the guys who are looking at that and trying to copy that are sub-$1 million businesses or sub-$2 million businesses, and the upper limits of scale for this kind of group mentorship, group coaching funnel, where it's a single offer franchise, could be 10 or $20 million a year in sales with better unit economics, better
Mm-hmm.
media economics. So it's like, okay, uh, maybe you shouldn't emulate what the biggest guys are doing, because maybe there's a reason that they're able to make that work that you're not.
Right. And it's still like, there's my view is that the industry's in an ongoing state of transformation, that we're not going to be done with for a few years at best.
Yeah.
And product models are changing, marketing models are changing. The other thing about the really large businesses is I've yet to, well, not yet. I can think of maybe one person I know who's pushed over 100 to 200 million, who's happy they did it. Everybody else hits 100 and they're like, what a mistake. Like, it's so rough
Yeah.
this way. Um, Once you get to a certain size, like, you're constantly dealing with lawsuits from, like, this manager down here did something inappropriate to this staff employee, and now you have a lawsuit. You're just dealing with all kinds of garbage.
Yeah.
And
Yeah.
that a happier business is actually in that $20 to $50 million range, from a business owner's perspective. Like, they're all pretty happy when they're, hit 10 million, and or 10 to 30 to 40. Like, yeah, there's problems. There's always issues. There's constant problems, but like, they're generally a lot less stress. There's great money, and it's a great place to be. And then I would say the other thing about, and this is a much bigger conversation that I keep meaning to do with, but like, I don't know how many people, it's more interesting than it is useful for most of us. And it has to do with looking at the actual, like, ecosystem models that have been used to build large companies. And that what you have is there's a marketing acquisition model for a franchise, and then there's a business model for having multiple franchises. And they're
Mhm.
two different things that are obviously related, but like, to get to like the large scale groups like MarketWise and Agora, there is a model there that is being used to create multiple franchises. And those franchises are going to range, from X to X. Sometimes they get really big, like they did in the 2021 period and leading up to it. And sometimes they're smaller, and what that is. But that's, for an individual publisher, it's like most guys have like, hey, I want a stable business at 20. Like, that would be great. Maybe 30, maybe push up, but like, you know, and with that, like, this kind of approach is really interesting
Yeah.
because there's a lot of people in a lot of niches who are making this work to 20 to 50 to even 100 in some cases,
Yep.
um, with essentially one or two product lines like this.
Yeah. Outside, I mean, even within our space, Sykes, I don't know what their top year on this model would have been, but I mean, do you have a sense of that ballpark?
I'm not gonna, out of respect for Zach and Tim, I'm not gonna say like what they've told
Okay.
me.
If you actually have it.
Um, it's substantial. They are a substantial business. They have done substantial numbers for a very long time.
Yeah.
Um, and
So even within our
yeah.
space, there've been significant results that way. But if you look outside of our space, there's real estate investment businesses and career op businesses that you've never even heard of that are doing 20, 30, $40 million a year in sales on this model. And frankly, with worse copy than is standard for our space. Like, even the shittier copywriters in our space are better than a lot of the writers in other spaces. Just because the gauntlet of financial copy having to come up with new promos so often to beat prior controls, because like all of a sudden AI isn't as hot as it was 6 weeks ago.
Mm-hmm.
um, it creates rapid iteration for writers. So even using not the best writers in our space to create a funnel like this, you got a shot at having a pretty substantial business.
Well, that's the thing, is that in a lot of spaces, just like you talk about the hero's journey copy, there's copywriters in other industries who never write a different type of promo.
Yeah, they write the same promo.
That's all they've ever written, and it's the same version of the same promo with a few different changes that they do, and that's just what they do. And so like the copy muscles of writers in this space are actually pretty phenomenal, because it's constant ideas, constant approaches, changes and approaches. There's so many different types of packages, and so much that can be applied within a guru model, a guru approach, because it's still a guru thing. It's
Yeah.
just a question of, is this trend idea leading? Is it this? Is it that? It's such a, like, I think of like the great financial copywriters are kind of like the super athletes of copy. And you're only competing in the hardest market there is.
Yeah.
Because of that. And so when you switch to like, hey, we're going to just like make the most perfect guru funnel possible, like that's a really interesting challenge for a copywriter, because it's about building the relationship really fast around this guy and highlighting and that's much easier than trying to time a trend with your ideas, which is what you're doing fundamentally with most other copy in the space. So
yeah.
And that's why I thought this was important to do, is that it is such a solid model, that it's worth being explored for. There's a lot of publishers who could add a significant amount of revenue really fast on a relative basis that is less of a workload than what they're used to doing right now. And so
I would say, even if you don't want to put together this particular model, a useful exercise to say, okay, let's assume that Porter's right, and the best version of this business is to have a structure of some kind to find your $25,000 buyer, $20,000 buyer, whatever it is, that very high ticket person who, those are the guys who are really paying attention. All right, if our business goal is to find that person, is the model that you're using right now the only way to find that person? Okay. Is it the best way to find that person? And I bet you the answer is no. I bet you that there are a multitude of other pathways to find that very, very high ticket buyer who, from a power law perspective, represents like a huge proportion of your overall revenue.
mm-hmm.
And this is one of them. And this is one of the ways to do it that involves the least complexity in terms of number of products in a franchise, in terms of frequency of putting out new promos,
Mm-hmm.
and it offers at first touch some of the best media economics. So it's definitely worth taking a crack.
Well, I think that too. So like your media economics. So let's come back to that for a few minutes too, just as to kind of wrap this up, because other than staff costs, media costs are the highest percentage of your spend that you're going to have in the business. Like your overhead goes to, like, if you can't spend on media, your business dies. And like that is where, like, when things are working, you ramp up the spend and things like that. So like if you were going to compare like wealth press media spend, and you guys caught YouTube at the right time when YouTube was really like cheap and productive, and it's gotten more expensive. How would you look at the two models in terms of like your economics?
So
you mentioned it earlier, but let's like dive into a little bit more real quick.
So we never made the front end acquisition model work. We couldn't get promos that converted at a high enough level at those price points for it to back out. So we, not because we're marketing geniuses, but because we literally couldn't make front ends work, shifted to selling back ends, direct to cold traffic, and our copy was strong there, but really like the biggest advantage was because of the higher price point and price elasticity in our space. Like there are pockets of people who, for them, spending $2,000 for an alert service is nothing. Like it literally doesn't faze them. It meant that it was much easier to have these things back out, even if the copy wasn't like AAA tier. And sometimes it was, but we had promos that were not even that great that still backed out. And we were looking for stuff to back out in a 72-hour period, positive ROAS in 72 hours. And that was more aggressive than I think a lot of different pubs even now, especially on front end acquisitions. I talk to people who are like 90 days. If it backs up by then, we're feeling good about it. For us, we were targeting 72 hours, and we could make that work with copy that was sometimes very good and sometimes was just more mediocre, but
Mhm.
still make it work because of that $2,000 price point. Once you get up to a $5,000 or $6,000 or $7,000 price point, that elasticity effect is still there. So you're not seeing, like, if this was all normally distributed, the drop off would be so pronounced that there wouldn't really be an advantage to going up the price curve versus a lower price point product. You like the conversion rate would decline kind of in proportion with price. But we, as you know, and as I think most people in the space know, that's not how it works.
Right.
So the conversion rate decline uh, doesn't completely offset the increase in price. So the economics again get better to the point where even with higher media costs today and worse targeting, you can get this to back out in that first pass period. And some people, especially outside of this niche, are running these funnels where cold traffic goes in and 72 hours later they've doubled their money. And
Right.
that's not like a
That's like
moonshot
early
at all.
2000s internet marketing numbers.
People are seeing this outside of this niche in real estate
Mhm.
investment. Like I know people who are doing this outside of this niche where if they start running a funnel like this, and if on their initial traffic they aren't seeing that like a double or better, because they know it'll decline a bit as they scale, but if they aren't seeing that off the hop, they consider that a failed funnel. So so I see that and I'm like, oh, you sweet summer child.
That's amazing. That's
but
amazing.
uh but so the economics is just way way better.
Right.
And
And I want to go back to something you said when you started this part, is that you said, you could
yeah,
make front ends work. And that's true for everybody. Like
yeah,
the best, I'm like, I don't care. The best publishers in the space, I've had conversations. Yeah, we haven't had a front end working in a year and a half
yeah,
at different points, right? Like that's
yeah,
the hardest part of the business, is making that front end work. And if even when you have the money and the staff and the best copywriters in the business, it's still the hardest part of this business to make that front end work. Now, when it works, it's phenomenal
yeah,
because you get this huge influx of paying customers, and then your back ends all explode. And so it's a fantastic model, but it's hard as hell.
yeah.
Um,
And it comes with other costs. Uh, when you're selling a front end, you need you really need to maximize the conversion rate. You don't necessarily need to do that with a $5,000 or $6,000 product. So in the copy for the $6,000 product, you can have a lot of hedging qualifying language that makes, frankly, the copy a lot more compliant and balances expectations with likely results. A lot of front end copy, the incentive is there. The market incentive is there for you to get as aggressive and up to the line as you possibly can within the regulatory framework. And that is fundamentally dangerous because as we know, where that regulatory line sits can change at any time, and we don't control that. So that's a problem. And then because you're selling such a large volume of units, the volume of complaints is necessarily going to be higher just as a function of scale. And we know that those complaints drive all kinds of things, from reputation issues
mhm.
to lawsuit issues from your own customer base to regulatory issues. So front ends, um, leaving aside the more challenging economics, have that whole other basket of issues that come with them that no matter what you do, like you can't eliminate those sorts of risks.
Right, right. And so that's yeah. I mean, the way this is sold by them, not everybody, but I know some people, that this is more like buying a car. You have a contract. You have a different approaches to how they do the close, but um, you have a higher price customer who tend to be less of a pain in the butt than
Yeah,
low price products customers. You tend to have a better customer base because they're much more qualified, they're much more engaged
yeah.
and much more interested specifically in this person and his approach. Um, and
Typically
so
lower refund rate too.
right, that's the fascinating thing, is that the refund rate is not like these crazy high refund numbers. They're actually relatively low compared, like
Yeah.
what you would expect from a front end in some cases. I mean,
Well, front ends often have higher refund rates than these
well,
products.
I mean, like I've seen guys with like 12% refund rates on this stuff, like,
Yeah.
and that's ridiculously low compared to like your average like $2,000 back end, $3,000 back
Yeah.
end.
Whereas if
We're
you're
much
selling a
higher.
front end with a money back guarantee, I can virtually assure you, especially to cold traffic, your refund rate is going to be higher than 12%. It doesn't matter how good the service is, it's going to be higher than 12%.
Right. So I think for everybody like who hasn't considered this model, it's worth talking about. And I'm trying to pull together more resources for everybody. Like I said, I'm doing another conversation like this with somebody who helps build these phone teams. We're going to talk to some other publishers who are doing this. But I thought this is a great way to talk because I think that, Conor, your experience building a more traditional FinPub and switching to this, I think is a sign of the times right now. I think it's a sign of where things are going. And also because the economics are so good that if you can make this model work, you can have a much more enjoyable business, both in terms of the top end numbers and in terms of like how much work it takes to run the business.
Yeah.
So thanks for doing this.
And just as a final note, real quick, as a publisher, if you have a one product franchise and you know that you can put all of your creativity on the product side into making this one experience better for the customers, honestly, I just feel better about putting out a product that I know is going to be solid and will continue to get more and more solid over time. And
That's
that there's you can't put a price or economics on that part of it.
that reminds me of a recent post Brett Holmes made about basically your products suck, people. Like,
Yeah.
you've gotten used to accepting lower quality product over the years. And I'm not saying everybody's product sucks, but there are definitely people whose products are lower quality than, or some of their products are lower quality than others. And there are people in the business who are like, the product doesn't matter. Like, ooh,
Yeah.
like, that's increasingly problematic, I think, in this environment. So
Totally.
So awesome. Thanks, man. This has been fantastic.
Yeah, this is good. I love doing these.
Take care. Bye.
Cheers.